What you're telling me is that music is about to stop, and we're going to be left holding the biggest bag of odorous excrement ever assembled in the history of capitalism. 1974, 1987, 92, 97, 2000, and whatever we want to call this. It's all just the same thing over and over. We can't help ourselves.
I say when we sell. Hey, I say when we sell.
Got to have the strong immune system to be a recurring guest on the last trade.
Exactly.
Mark, yeah, it's nice to see you. We had a nice 10-minute dialogue before we hit record that I'm sure the audience would have loved to hear, but that may be for an exclusive last trade in-person event whenever we get that on the books of Mark.
Yeah, again, that's the teaser, right? That you get the behind-the-scenes stuff, you get the outtakes. You know, if you show up in person, yeah, I like that. Love that idea. So, but great to be back, and great to see everybody. Hope everybody had good holidays.
Yeah, it's great to have you back, Mark. It's you are a fan favorite. You're a host favorite. We enjoy the conversations, and we're looking forward to having you back on. There's a lot of topics we could discuss, conspiracy or not. But I think where we should start, because people listen to this podcast not for our conspiracy takes,
it's only a conspiracy if it isn't true.
Right. Fortunately, we can't get to that just yet. Maybe we could save the last 10 minutes for that if people stick around. But what we really need to talk about first is what's been going on this year with the Bitcoin price. And less about the price, but more so about just market structure. Because if we take a step back, we had you on the show in May, actually Bitcoin Pizza Day. I remember you standing on your desk chair and you showed us your socks.
Oh, okay. So I'll do it again. I'll stand up. I don't have the Bitcoin Pizza socks, but I do have, interestingly enough, I have the Bitcoin Moon socks.
Okay. Well, that's a good sign. I wanted to see that.
And you're like, wait a minute, Yusko, you're the guy who says we're in crypto winter. How can you be wearing the Moon socks? They're not mutually exclusive, right? It's just about time frames. It's just about, ultimate destination. The ultimate destination is the moon. But I also do believe we are, like I said, it's cold outside. It is crypto winter, but we can talk about why I think that. And look, I talked about this on the show. But anyway, I interrupted you with my socks. So you were going to say, I showed you the Bitcoin Pizza socks and
the price at the time was $111,000. So we're recording on December 4th. This will be live tomorrow and Friday. The price is currently $92,000. We withstanded a drawdown to perhaps even below 80K, and we did not see a euphoric blow off top that would be categorized by previous market cycles. And now there's debate on both sides. Are we going to be in a bear market, prolonged bear market like we have historically? Or are things going to be looking up in 2026? But before we get into 26, Mark, I just want to better understand where you're coming from. Like, what's your assessment of what's happened this year?
I want to add one extra layer because of the timing. If we're going to further this ChatGPT prompt, let's say that it's a year from Thanksgiving last year. Last year, you're bullish, Bitcoin's running. Now your family's asking, what the hell happened, Mark? The prices, we're backwards. Trump's in.
Like, absolutely. And look, and to that point, Thanksgiving is such a wonderful Bitcoin holiday, right? And the interesting thing about it is for years, it was like kids' table. We're not going to talk about this. We're going to talk about football. We're going to talk about politics, but we're not going to talk about this crazy magic internet money. So you go sit at the kids' table. You really weren't welcome as a Bitcoiner. Then call it, 5 years ago, we broke out of remember, 2009 to 15, not only wasn't it talked about, because that was the first they ignore you phase. No one really knew. I mean, a few people knew about it, but most people had no idea. And you certainly weren't going to bring it up at a family conversation where no one else had anything to say because it just wasn't useful. And you hadn't made a ton of money yet. Some people had made some money, but a lot of people hadn't made a lot of money yet. So then we get into the then they laugh at you phase. And that was the, 2010 to kind of 16. sure, people made some money and the price started to get to meaningful levels. By 17, we hit 10,000 and then 20,000. And remember, that was the first Thanksgiving where everyone was talking about it, 2017. And on November 6th, we hit 10,000 for the first time. And it had been $900 in January. So people were like, hey, come off the kids' table, come over to the main table, right? You can sit at the main table. And literally enough, kids, because it was mostly young people, convinced Uncle Mike or Cousin Joe to buy some. And in 5 weeks, by December 18th, we hit 20,000. Think about that. We doubled. Kind of between Thanksgiving and 3 weeks later, we doubled. And then the proverbial shitteth, hitteth the fanneth. If you watch 10 Things I Hate About You, one of my favorite movies. So what happened? Well, there's this guy, Leo Melamed. I don't know. Again, you want to talk, this is not conspiracy, right? Conspiracy is when something's not true. This is true. Leo Melamed is a real person. He is the chairman emeritus, was the former CEO of the Chicago Mercantile Exchange. And in 2017, kind of during the run-up, he famously said, oh, don't worry, we will tame Bitcoin. That's a weird word, right? Like, it's not a wild animal. I mean, what do you need to tame it? Well, December 18th was the peak at 20,000. It's not a coincidence that that was the day that the CME introduced Bitcoin futures. Because why does that matter? Well, in the good old days, if we wanted to transact in Bitcoin, I either had to have a Bitcoin or one of you had to have a Bitcoin, and we could transact that Bitcoin. It's like again, you guys, Michael, you were just in Oklahoma. I was in Oklahoma for the holiday. And, oil country. And in the old days, if Clan Miller, so what's your family name in Oklahoma?
I wasn't in Oklahoma, but I'm from Texas, so I might as well. I might as well be close.
I thought you said Norman. All right. So let's pretend your family's in Norman. So it's the Taguma family. So Clan Miller, that's my wife's family, wants to trade some oil with Clan Tanguma. And that Clan Miller actually had to have the oil to send to the other family. But then futures came along, and now we don't have to have the oil anymore. We can just write a contract. And the nasty thing about contracts, you can take one side out of thin air. Like, you can literally sell a paper Bitcoin. And so if you, again, follow the money, some big institutions started going short BTC through the futures market, and the price started to fall. And then people got afraid, and it fell more, and we dropped to 10, then we dropped to 6, and we're in the crypto winter. And if you remember, the following November, kind of November 7th, 8th, I can't remember the exact day, we were sitting at 6K, and we dropped to 3,400, like in 2 days. And I remember sitting around our partners group meeting saying, what the hell was that? And you can go back and you can look. It was a liquidation of, some levered traders. Long story short, that Thanksgiving, back 2018, back to the kids' table. In fact, maybe you're not even invited this year. So, next Thanksgiving, fine, 19, fine, 20, fine, 21. That was the best Thanksgiving ever, right? We're at 69,000. You get 2 turkey legs, like it's the Madden turkey, right? You get multiple turkey legs. Did it the top. Yeah, awesome. Exactly. It's unbelievable, right? Everybody loved you, 2021. And then bang, crypto winter. And I remember I was on a podcast pretty regularly back then, before we started Digital Currents. And I said, you know, 4-year cycle still intact. And again, not coincidentally, and it's actually not a 4-year cycle. This is part of the problem. It's a 3.11 cycle. It's 3 years and 11 months because it's not based on months, it's based on blocks. So it's 3 years, 11 months. So December 2017, November 2021, and October 2025. So now we have this problem of this year, right? Which is October 6th is the peak, and then we go down. So now you show up this Thanksgiving, and while we were all getting ready for, Moonvember, like my socks, everybody was like, oh, okay, Uptober didn't happen. Uptober got canceled, but we're going to have Moonvember, and it's going to be awesome. And so everybody's all excited, going to get double pumpkin pie this year. And then, we're hitting 80-something, and I'm sure you guys experienced it. We weren't talking a lot about Bitcoin. People were kind of, so, Mark, what do you want to talk about? How about them Irish? I mean, nobody wanted to talk about Bitcoin. I'm like, guys, it's okay. We're okay. I mean, yeah, I first of all, I didn't buy all my Bitcoin at 126,000, so I'm fine. But it was a little dicey. So this all goes back to, where are we? I believe, and I might be more minority, maybe it's 70-30, 80-20, who are leaning now into the, nope, 4-year cycle's dead and institutions are here and it's up only. Yeah, I'm on the other side. I think the 311 cycle still exists. I think humans are going to human. And I think this cycle was truncated in amplitude for a couple of reasons. Then you say, what do you mean? Well, cycle 1, 2017, we got to 2 times fair value. Well, what are you talking about, fair value? Fair value, actually very easy to determine. Tim Peterson at N Squared Value does it all the time. He's got a model. He actually even releases it on the internet sometimes. I've been looking at it since 2014, and it's been incredibly accurate. And it's just math, right? You can value a network based on a bunch of criteria, and you can calculate a value. Fair value was 10. We got to 20. That's 2x. That's too high. We were going to crash. And the problem is you don't crash back to fair value. You crash through fair value because leverage gets involved. The only way you get to 2 times fair value of anything is leverage. So fast forward to 2021, fair value was 32, 33. We got to 69. Again, 2 times fair value. Bang. We collapse, go all the way to 15. Now, we probably shouldn't have gone quite as far the second time as the first time, but we had the FTX scandal in there, so that exacerbated. So this time we get to 126. Fair value is 91. Not 2 times fair value, kind of, 135% of fair value. Oh, how much downside? Well, not as much downside. Well, why didn't we get as high? I actually thought, and I talked about this in January, saying, look, no one's going to want to hear this. People are going to yell at me, but I think we're going to have the cycle. I think we peak late third quarter, early fourth quarter. Fourth quarter is kind of crappy, and we enter another winter, and we have to suck it up until, next Thanksgiving, 26. So here we are, and we fall, but we don't fall as far because the reason we didn't get up as high is there wasn't much leverage. You used to be able to get 100 times leverage. Then it was 50. And then it was 20. It's still, you can still get decent leverage in some places, but it's not as much. And to me, that's the first piece. The second piece is there's a massive amount of leverage in the traditional markets, like super high levels of margin debt. Everybody is, playing in the options market. I mean, it's become Like, so I read this morning. I wish I could give credit to who said it, but it's so true. It's the greatest rebrand in history to call gambling prediction markets. I mean, that is magical. Like, if you were the person who was so addicted that you'd go to Vegas and gamble on sports, you were less of a person in other people's eyes. Now, oh, you're a participant in prediction markets. Oh, you must be really smart. It's hilarious. So, and she's the wealthiest self-made billionaire in history. I mean, the youngest self-made billionaire in history. I mean, that's crazy, but good for her. Good, I guess. Because gambling is probably the second oldest profession, right, in history. And you're not going to control it or stop it. So, and it's partly, it's interesting. Depends what you believe lockdowns were. If you think lockdowns were an accident and a response, then, the fact that people couldn't go to Vegas and so they started gambling in the stock market is just happenstance. If you believe, and I won't say which side I'm on, but it's probably pretty clear. If you believe that it wasn't an accident and it was purely intentional, then perhaps this has been the game all along. And if you go really deep into 1984, this is how you destroy societies, right? You threaten family values, you get people addicted to certain things, whether it's substances or drugs or activities, and you make people dependent on government largesse.
All right, loyal listeners of The Last Trade, we are piloting out flat-based pricing. That means that your fees do not increase with the price of Bitcoin. We also have lowest cost trade fees in the industry, an IRA included in every account at no additional charge, and a special end-of-year incentive. We only have a few more weeks left in the year, so anyone who wants to get more information on the end-of-year incentive, email me directly, jackson@onrampbitcoin.com. Again, no fees that increase with the price of Bitcoin, lowest trade fees in the industry to buy Bitcoin, and an IRA included in every account.
Maybe taking a quick detour, just on the prediction market stuff. Curious where you sit there, because I think there's two discussions. Like, one is gambling, and there's been good, I need to get off X, but there's been some good dialogue around how like sports are cooked, like just in general, like products are cooked just with this system for a number of reasons. And so the main reason people look at sports today is really gambling. And then the other side of it is ultimately, it's the lottery ticket. It's either, perps or prediction markets. So that's one side of society just like in decay. But on the other side, I initially was like all prediction markets, and I still don't know where I sit. That's why I'm curious on your response of listening to, Joey Krug talking about how Polymarket was initially founded, and looking at, there was another, I guess Susquehanna is the largest market maker. Yep. And so they come out, and of course they're talking their book, but explaining how from a geopolitical perspective, you can have, I think it was like the Venezuela, whatever's going on down there, and they have it priced at like 50%, when if you ask most people, they would say like, that's not going to happen. Nothing's going to happen down there. So curious, do you see there's any signal of like a societal improvement by having an open free market, being able to discern where the signal is versus having it within a tight group? I don't know where I sit. That's what I'm curious.
It's a great question to ponder. Not only would I not argue, I would enthusiastically support the construct that prediction markets and the hive mind is far better at discerning probabilities of unknown events than individuals, right? I think there's lots of data on that, and makes sense, because some of those individuals might actually have some knowledge or some inside information, so to speak, or know how to do probabilities better, whereas most people are generally pretty bad and generally less informed, not uninformed, but just a whole group of people distributed around the world are going to have more information. Now, that doesn't mean that groups are good at everything. Like I say all the time, right? Investment committee should be an odd number, and 3 is too many, right? The best investment committee is a single person because groups tend to make decisions that keep them in the group as opposed to say what's really on their mind. And so there are things that the prediction markets aren't good at. But I think I would say it's incontrovertible that your point on, is there information content? Is there more signal than noise? Definitely, right? And in fact, they're really important in the sense of, in a world of digital abundance or electronic abundance, whichever one you want, where everything's now available all the time and a whole bunch of stuff that isn't real, isn't useful, like opinions. They're not really useful. Like one of my favorite, stories is Seth Klarman, famous manager at Baupost. They're at their Monday meeting and he says, all right, what do we know about this particular merger? And the one analyst says, well, he says, I did not ask you what you think. I will never ask you what you think. Your job is not to think. I asked you, what do we know? What facts do we have? Go get me the facts. And he wasn't trying to be dismissive. He's like, look, I'm not asking you to think. I'm not asking for opinions. I want us, who's a pretty smart group, to analyze facts and data. And so in a world full, like, look what's happening with the CFP stuff right now. Oh my God. I mean, it's relentless. The consternation, the torturing the data, and everybody's biased and everybody's got opinions. Like, that's not what matters, is the facts. Like,
let's just talk about Lane Kiffin if we're going to go to college football. We don't have to go to
oh my God. Well, and here's the funny thing about that, right? We were talking off air about, familial relationships, spousal relationships. There's things you disagree on. There's things you really disagree on. There's things you just can't talk about. And then there's stuff you get divorced over. But Lane Kiffin, all the women love this guy. I mean, what a dirtbag. I mean, he is a bad person. And he's not even, based on data, maybe he's not even a great coach. But man, how do you show your true stripes? And maybe I shouldn't say this about another person, but holy moly. I mean, I'm blown away at the lack of loyalty, the lack of polish, just the lack of, but worse are the people who want to penalize the kids. Oh, they shouldn't be in the tournament. Are you joking? I mean, the kids did nothing wrong. And I would make the argument, I've made this argument many times, there's a whole bunch of times where if you just took the coaches off the field, the kids would be better. Because they know what to do. They just don't want to be yelled at. They don't want to be belittled. It's Brian Kelly's big problem. That's why he's no longer at LSU. Then I will give my dig to Louisiana like everybody else. You're paying 3 coaches $140 million to have the lowest literacy rate in the country. That's a priority problem.
Yeah, the college football stuff's fascinating. I haven't paid attention as much sports ball, but seeing the Lane Kiffin situation and how it was happening midseason, I couldn't help but notice. To help Jackson bring this back, because I want to share 2 things. One, disagree with something he said, and then instead of saying this is what I think, say the facts. I would say we've still been in a Bitcoin bear market in gold terms.
I know. I love that point. And here's the thing. If 2 people always have the same opinion, one is unnecessary. So I love dialogue and debate, right? I live for dialogue and debate. If people always agree, that's just not fun at all. And it's not interesting and we'll never find truth. So you never have to apologize for quote unquote disagreeing or taking the other side.
Well, let me just finish the thought and then get your response. So, because you were keen on something that we're in potential over fair market value and the cycle maybe topped and how you're going down that thread, I don't think it's even started yet. I could share more, but I mean, that's the basic
look,
genesis.
I am compelled. I'm compelled by that argument. I would have to look at the data and starting points, because I will agree vociferously with the premise that 1 ounce of gold is 1 ounce of gold, the same way that 1 Bitcoin is 1 Bitcoin. Those never change. Everyone's like, oh, the price of gold went up. No, it didn't. Gold did not change. Gold did not change. What changed is the currency you value it in, whether that be lira or bolivars or dollars or yen. So gold has never changed. And gold, undisputed champion of this, 5,000 years, same store of value. If you exchanged a single ounce 5,000 years ago, you got a fine person's suit. 2,000 years ago, a fine person's suit. 100 years ago, a fine person's suit. Today in Savile Row, a fine person's suit. So a single ounce has been a perfect store of value, a perfect money. Up to Bitcoin, it was the only money in the world. Like, Mark, what are you talking about? There's lots of money. No, there's lots of currencies, but there's only ever been one. And that's not true. There were things before gold, cowrie shells and stone wheels, but we eventually ended up with gold. But money's an asset that exists in the absence of a liability. So I totally agree with you that gold is the standard. We might quibble a little in that, like, people say, well, gold outperformed this year and gold outperformed Bitcoin this year. I'm like, yeah, but all you can do is back up 3 months and it's a dead heat. And if I back up 13 months, Bitcoin's ahead. So the beginning and the ending period matter. And I will argue that if you go back to the seminal event, lockdowns, and it wasn't the lockdowns themselves, but the response fueled by the cult of Kelton, as I refer to it, Stephanie Kelton, maybe the dumbest economist in the world, which is like jumbo shrimp, right? I mean, it's an oxymoron to say a dumb economist. I mean, it's called the dismal science for a reason. It's not really a science. I mean, it's a bunch of opinions, and we cultify them. There are Keynesians, and there are, Edwardians, and there are, Austrians. So we cultify it, but at the end of it, and the Austrians are the closest thing to real because they base it on gold. But the cult of Kelton is crazy. I mean, this woman actually believes that you can issue as much debt as you want and it won't cause inflation. I mean, it's mathematically disprovable. It's just a silly statement. But anyway, they printed more money in an 18-month period than the previous 245 years. That was going to end up in both the price of gold and the price of Bitcoin. So if we go back to that date and look, then the comparison, I think, is...
Well, I think the two things to add is they're not in a vacuum. I think most people would agree that the trading pair for money is energy. So barrels of oil would be the all-time highs, and it hasn't passed that in gold terms. But the other side of it is breaking down like 3 anecdotes that what I think drives Bitcoin's bull markets is reflexivity, because reflexivity is what drives in net new demand. And 3 particular anecdotes is, one, most people listening to this and us haven't had net new people, friends, networks step into the market in size.
Yeah.
The other one is just randomly talking, one of the largest hardware manufacturers have just been a decline since 21. So there's been net new buyers there. And then the last one just stumbled on because we have a venture arm, and you just don't see a lot of net new entrepreneurs, which are generally a signal for a positive market because of wealth appreciation and recognition of the underlying. And so when you tie all that into it, and then you look at the trading pair, which is barrels of oil, I just don't think it's gotten started, which I think is bullish because it means we have a lot more room to run. But anyway, that's just kind of, I was going to initially say that as an opinion, but it's objective when it comes to...
No, and I agree with it. I do agree with it. And yet maybe I would step back a little bit and say that probably is more inextricably linked to the liquidity cycle and the business cycle, which historically has been a 7-year cycle. Lately, it's been extended because of QE and QT and all that kind of nonsense. So it's been a little bit tough to read the data. But historically, it was 7 years like clockwork. And then every 14 years, we had the technological innovation that when you couple the innovation wave with the liquidity cycle and the entrepreneurs who get laid off from real jobs during the previous downturn, when you get those three things, you get massive venture returns. And the last best one was 1996. Since then, we've had a number of venture years where you get two of the three, but you need all three. And I will argue this cycle 24, you had all three. And so I think the venture returns from 24, 25 are going to be spectacular. But I agree with you that since then, there has been a noticeable decline. And I think part of it is, unlike the internet, so if you think about all the cycles, right? There was the mainframe cycle in 54, then the microchip cycle in 68. There were a lot of industries that you could improve with those innovations. First it was like governments going to business, and then it was big business going to small business. Then the personal computer came along, and that was the beginnings of connectivity. But it really wasn't until 2010 when we had these things, right? I mean, what's crazy is in 2007, when Apple released the first iPhone, their stock fell 40% because people were like, I'll never pay $500 for a phone. No, you won't. You'll pay $1,500 for a supercomputer. It's not a phone. When was the last time you actually talked on it? I mean, you do stuff with it that's seemingly impossible, but you extended so many businesses and so many opportunities to create wealth by creating new businesses. This innovation, the truth net, as I call it, or blockchain or Bitcoin, whatever you want to focus on, there's only one industry, really. I mean, it's financial services. I mean, there are some other applications, but it's really about money and financial services, which is the biggest industry in the world. And it's not close. Like, the internet revolutionized commerce, media, $7 trillion of value, huge, awesome. Financial services is $7 trillion a year of fees that we pay for the trust of safekeeping of our assets. We can displace all of that. Now, the problem with that, as you guys I'm sure have experienced, Jamie and co don't like that, right? They kind of like their revenues. So now, I said, 2009 to 15 was the first they ignored you phase. Then 16 to 21 was the, then they laugh at you phase. And now we're in 21 or 22 to 27, the then they fight you phase. And so we're still a couple years away from the fight. And the fight is real. But then, how the story ends is then you win. I will argue if you're here, if you're listening to this podcast, if you are a holder of Bitcoin, you've already won because you get the joke. And we were talking before we came on air. I finally busted out of Twitter jail. I was in Twitter jail for better part of 2 years. And I couldn't figure out why. I mean, I got in jail the first time because of saying the wrong thing about the wrong topics around lockdowns, but whatever. But I got out of that one. But then I got in again. And I'm like, what the hell? And it wasn't that I did anything wrong. It was just I was using Twitter wrong. The fact that I won't call it X and I call it tweets instead of post is probably part of it, but which I'll never do. But I busted out because I asked Grok, what should I do to get the algorithm to like me again? And it said, do these things. And I did these things and bam. And a bunch of things happened and people started seeing my stuff again. But I did tweet this out the other day. I said, the goal isn't to have the most currency, right? The goal is to have the most purchasing power. That's how you win. And purchasing power can be stored in lots of different ways. It can be stored in barrels of oil, it can be stored in bricks of gold, it can be stored in Bitcoin, it can be stored in land. I mean, there are a lot of ways to store purchasing power, but it isn't to have a bunch of numbers on a page, because those numbers on a page have to be converted into dirty fiat to pay for the $20 hamburger, which is about to be 25 or 30. So crazy stuff.
When it comes to holding Bitcoin securely, peace of mind starts with architecture. Onramp's multi-institution custody distributes control across 3 independent regulated key holders in a 2 of 3 quorum. No single point of failure, no pooled or omnibus exposure, segregated client-titled vaults. You retain full legal ownership while Onramp coordinates security, compliance, and operational workflows behind the scenes. It's strength of many delivered through the simplicity of one. Multi-institution custody is the foundation for everything we build. Sound infrastructure that distributes counterparty risk and provides fault-tolerant resilience with clear audits and institutional controls. And now Onramp is piloting flat, predictable pricing, making best-in-class Bitcoin custody and financial services more accessible now than ever. Onramp, strength in many, simplicity in one. To learn more, check out onrampbitcoin.com. So Mark, if I could get your thoughts, trying to bridge the gap between your thinking and Michael's thinking and some of mine as well, right? So you'd made the case that cycles over time are still intact, 3 years, 11 months, fair value for Bitcoin price. Michael makes the case that if you denominate Bitcoin in another asset like gold, then we're still in a bear market, haven't hit new all-time highs there. I have a question if you can kind of pull in the macro story now, because if we look back to the previous cycle, we had the alignment between easy monetary policy and fiscal policy that you spoke to. And then the cycle peaked out in tandem with the Federal Reserve and global central banks hiking rates, quantitative tightening. And now we're kind of in a opposite situation where we've completed the 3-year, 11-month cycle, to your point. But now it's a question mark of where do we go from here from the macro picture? It seems that things are going to be easing. And so I want to get your thoughts in terms of like macro conditions and what the implications are for Bitcoin and other asset classes. My other thought as well, or question is, well, you have a case for fair value for Bitcoin, but the people in the equity markets who have been pointing out that equity markets have been well beyond their fair value for a number of years now, if you look at different fundamental ratios, well, equity markets continue to price new all-time highs, price earnings continue to go up. And so like, why is Bitcoin correcting to fair market where you have other asset classes that continue to stretch valuations in addition to a macro condition that seems to be pretty supportive?
It's such an insightful question and such an important question. One little thing, chart crime, you got to use log scale if you show anything more than 5 years. But that said, it's my personal pet peeve.
Did Michael get me in trouble or did Brian?
No. Again, it's not a big deal. It's just everyone shows these charts and they need to be log scale. If it's a long period of time, it's got to be log scale. Like everyone shows the debt chart. Well, yeah, because you're showing 100 years, the first increase for the first 90 years. But anyway, your question is so important because at the end of the day, Michael and I are talking about the same thing on different time frames. I'm talking about kind of a trading time frame. He's talking about a wealth accumulation time frame. And so both can be right. It's like when someone's long a stock and someone's short a stock. They can both be right. It's just about time frames, right? Someone could miss earnings, but still be a great buy long term, but you don't care about earnings and you're not going to trade. So that's the first part. The second part, again, the really, really insightful part is, well, wait a second. These other asset classes that are huge, by every measure, are the most expensive they've ever been. Like worse than 2000, worse than 29, worse than 1846. I mean, bad. But they stay that. Well, it's because the game's rigged. And the game's rigged because all my brethren and sisterin are in charge. So the boomers, right, have been in charge for a while. And the boomers created a system to perpetuate the system that their parents created. The silent generation created entitlements. Now, what's an entitlement? An entitlement is a promise that you make to yourself that you don't fund and you ask your kids to pay for. Who would not vote for that? Everyone would vote for that. So the first generation, the silent generation, scarred by the Depression, said, we are never going to have that again. So we're going to set up these systems like Social Security, and then later after post-war, other things to make sure that we take care of the vulnerable. Okay, it's good. Now, basically what you created are insurance companies. If you create an insurance company, you should run it like an insurance company. What does that mean? Well, what does an insurance company do? They take in premiums, they invest the premiums and make money, and then pay claims later. So they use the money to invest while they hold it, and then they pay out and they keep the spread. It's a beautiful business, one of the best businesses in the world. The reason Berkshire Hathaway is so important is they're an insurance company that has negative cost of capital money because they get paid to hold the money, and they invest in a leveraged index fund. Mad genius. And it's tax deferred, so it's even better. So government of Singapore does this, Temasek does this. We don't do that. Like, my mom believes that there's a little pot of money in DC called Judy's money. There is no pot. She's getting paid by me and my wife. Okay? That's who's paying for her, not specifically out of our paycheck, but it's the kids who are paying. The problem, when you set up the system, there were 17 workers for every retiree. When I reach retirement age, notice I didn't say retire because I will not be able to, there will be 2. And I always said, we had 2 kids, or had 2 kids, and I lose. The money goes to my wife, I lose. So I had to have a 3rd kid. So we had a caboose. So, I have a 14-year-old now, in addition to my older kids. Still need 1 more to get paid. But a pay-as-you-go system will go broke. So you just, as long as you die before it goes broke, you're happy because you don't really care. So the boomers set it up. But when they saw that the only way out was to inflate the value of the fiat assets, stocks, the Tax Act of 1986, which had nothing to do with taxes, had everything to do with 401ks and corporate earnings. So, pre-1986, again, silent generation, company will take care of you in your old age. You'll have a pension, and it'll be a defined benefit, meaning you work for a number of years, you get a certain amount. That was very expensive because you had to put the money in, you had to invest it, and there were professionals that invested it. That's a very important point. Professionals invested it, and we modified from the 1950s when it was basically deemed irresponsible to own anything but bonds. But over the long term, the dumbest thing you could ever own is a bond, because every day you own the bond, all your returns are getting chipped away by inflation, the devaluation of the currency. So you need to own equity and private equity and real estate and commodities. So they had diversified portfolios, and ERISA came along and in 73 and said, you got to diversify and you got to own these other assets. And so they're professionally managed, and they gave people a defined benefit, a comfort. But they were expensive because you had to put money in. So someone came up with this and I said, what if we created this new thing called defined contribution? Oh, and here's the cool thing. It'll be portable, because in the 80s, people were starting to leave jobs and they weren't staying with one company for 40 years. They might want to change jobs. And so they could take their assets with them. Oh, that sounds good. And guess who wrote that bill? Vanguard and Blackstone. Vanguard and Fidelity. Huh. What do? They offer these things called mutual funds. Where's all the money go? Into mutual funds. And they charge fees. Now, they've convinced people that, they charge low fees. It doesn't matter. They still charge fees. Worse, the average person, when they get their 401k, they go into the HR person and they do 1/n. If they have 5 choices, they put 20% in each. If they have 10 choices, they put 10% in each. If they have 5 choices and 3 of them are bond choices, they are 60% bonds. If they have 10 choices and 7 of them are bonds, they're 70% bonds. And they never change. It should be against the law to own a bond in a 401k. Should be against the law because you can't touch the money for 45, 50, 60 years. You should be forced to own equities and private equity and venture capital. But lots and lots of bonds, tons and tons of bonds. So the average 401k is underfunded, not going to provide the same level of benefit as DB. But then what really happened, because, man, it's always the contribution for DC versus DB was 30% lower. So corporate earnings went up 30%. Who made all that money? Management. Because at the time, no one owned any stock yet. They were starting to accumulate. So all the money went to management through options and other things. So then what happens? So then Uncle Warren comes along and says, a bunch of these companies look really good. How about I buy a bunch of them and then we cut a deal where you buy back the stock. And so I get a dividend into my trust that I'm buying with levered assets, and then I have a tax deferral. So his stock, if you plot it against the S&P, it's like a 1.5x the S&P, except when he goes to cash, which is always an interesting warning sign. Anyway, I've digressed a lot, but the point is that the game is rigged. Every 2 weeks, money goes into stocks, into the S&P index fund, and the S&P index fund are dumb. And I don't mean unintelligent. I mean, they are rule-based. 3 years ago, the weighting of NVIDIA in the S&P was 0.7%. Today is 7.8%. Every dollar that went in on Monday, because Monday was a contribution day, had to buy 7.8% of NVIDIA, irregardless of the fact that it's selling at 30 times revenues, which is a dumb number and will eventually come home to roost. But when? That's the tricky part. As long as the 401ks are coming in every 2 weeks and they are forced to buy index funds because now we have more money in passive than active, that will keep happening. So that's the long-winded way of saying the problem with Bitcoin having more volatility, ownership's not as broad. It's not systematized at all. Now, that's about to change. What happened yesterday or 2 days ago? Vanguard said, even though the original guy said over my dead body, basically said, as long as I'm CEO, he's gone. So his body, got dead, I guess.
Is he still alive?
He's still alive, but he's gone. And they are now going to now, if you want to get into really deep, dark conspiracies, you can make a really good argument that all the FUD around de-indexing MSTR that started on the same time as the peak around the first week of October and the, Trump back whale, people are saying it was Trump. I don't know if it was or wasn't, but the Trump back whale who got short on that same time. All of this stuff might have been the oldest trick in the book. Like I tell this story, Julian Robertson, dear friend, mentor, God rest his soul, one of the greatest investors, not maybe, one of the greatest investors of all time. There's a great story. Dwight Anderson, famous hedge fund guy, worked at Julian's shop. Julian said, all right, Dwight, you're the macro guy. I want to get long copper. And Dwight said, okay, great. I'll go put an order. He says, no. I don't want you to buy copper. I want you to go short 50 million of copper. And I want you to call Morgan Stanley and Goldman Sachs, and I want you to tell them how much we hate copper. And Dwight's like, no, I thought you said you wanted to get long copper. He says, well, I do, but I want to get long at a lower price. So this has been going on for a very, very long time, that when somebody knows that they have to buy a bunch of something, they FUD it to make the price go down so they can buy. So I'm not accusing BlackRock or Vanguard of anything, but it is certainly possible, if you look at the futures data, that someone's been shorting the crud out of, and someone's been,
Picking up spot.
Closing out the levered long.
Well, maybe can we dig a little there, because it's an interesting time recording this off the backs of price retrace, and then this specific, call it 3 to 5 business days. Late last week, it was JPM coming out with a structured note. There was Vanguard, obviously, we just touched on. Charles Schwab, they've been talking about it, but highlighting that it's going to be like Q1 or Q2. B of A, now 1 to 4%. There's probably one or two others. Like, it's very interesting. Oh, and then the credit ratings and the Tether FUD coming out. Curious, like, any takes or color you want to add on where we're at right now?
I don't believe in coincidences. I don't. And I certainly don't believe in coincidences when the parties are so inextricably linked, right? I mean, it'd be one thing if one of those organizations was in China and another one was in Brazil and another one was but if they're all 4 doors down from each other on Wall Street, it's probably not surprising that, they're doing the same thing around the same time. And look, there are other things that go into it. I mean, the end of the month is always super tough, because when you start futures, the futures price is always a little bit higher than the spot price because humans are optimistic. And then you roll down the curve over the course of the month to get back to spot. And that's called roll yield. And so one of the challenges of these closed-end funds that deal in futures instead of spot, like, remember when the only thing you could buy was the Bitcoin futures fund that, I can't remember which firm it was, but the guys, I think they're in Nashville, did. And people say, well, Bitcoin's up 10 and they're up 7. Why is that? Well, it's because the roll yield costs them money all month. And so, GSCI futures, the same thing. So every month at the end of the month, you've got this resetting of that trade for the next month, because I love when people say, oh, Millennium, they bought 2 billion of IBIT. Yeah, but they're short 2 billion of futures against it. So they're not long. They are a market neutral fund. If you say they're long Nvidia, they're short Cisco or something else. I mean, they don't take long positions. They go market neutral, dollar neutral. It's never market neutral, but dollar neutral, and they lever. So if you can make 10, 11% in the futures roll yield trade and lever it up 4 or 5 times, even if you're paying 5%, you can make 30, 40% compounded. Jane Street and Jump and, Susquehanna and all these guys, they love that. But it all has to get reset at the end of the month. Now, the other one, you guys are you're going to love this. You're going to say, we're never inviting him back after this one. So there is a very interesting study that was done. So do you guys know Sam Branham? Do you know that name?
I don't think I do.
He was a famous commodity trader in the 1800s, and he wrote this book. And you see the one page from his book all the time. And it's basically this up and down cycle, and it has peaks and troughs in markets. And he wrote it in 1860s, and it basically predicted the crash in 1929. It predicted the crash in 73. It predicted the crash in 2000. It predicted the rallies. It's been spot on for 150 years. And it's based on the position of the sun, moon, and planets. And that's voodoo. What are you talking about? Well, human beings are controlled, shall we say, by emotions, and there is a lot of evidence that says we tend to cycle. Women absolutely cycle, just like but men also follow cycles, and one of them happens to be the lunar cycle. And so a guy did a study. If you bought assets on the new moon and sold them on the full moon, so you were invested 2 weeks of the month and in cash 2 weeks of the month, you do 1,400 times, not 1,400%, 1,400 times better over the last 100 years. Everybody's like, Mark, that's just bullshit. I'm like, it's data. You can do the data and you can look at it and you say, well, that's spurious correlation. Maybe. Now, what's interesting, you say, okay, but Mark, this week was the full moon, so you should be selling Bitcoin. And I can't explain this one, but Bitcoin, so I actually dug into this. Bitcoin does the opposite of everything else. It is better if you buy on the full moon and sell on the new moon, which is weird. And anyway, so
it's alien technology. It's just alien technology.
Well, you know what? Maybe it is, or is Bennett in China, so it's on the upside down? I don't know.
Here's the conversation no one wants to have. If something happened to you tomorrow, could your family access your Bitcoin? Really think about it. The seed phrase hidden in your house, the hardware wallet in the safe, that complex multi-sig setup. You understand it, but does your spouse? Do your children? Billions in Bitcoin are already lost forever because people did not plan for this moment. Onramp's inheritance solution is built into our multi-institution custody from day one. 3 institutions, clear beneficiary designation, and professional succession planning. No technical knowledge required from your heirs. And with our new flat tier pricing starting at $250 monthly, your family won't face surprise custody costs just because Bitcoin appreciated. The same predictable fee whether Bitcoin hits 200K or 2 million. Don't leave your family's future to chance. There's strength in many. Visit onrampbitcoin.com/inheritance. That is onrampbitcoin.com/inheritance. I have one question, Mark, on some of what you discussed around hedge funds netting out positions, right, with futures contracts. One thing, so Brian writes our weekly research roundup, and people should subscribe in the description if they don't follow that. But Brian was writing about some of the endowment portfolios, and there was an article that came out from Institutional Investor about, I can pull it up here, but it's pretty much like crypto is the secret sauce that endowment portfolios don't want to discuss. Oh, here we go.
Yep.
And so Harvard, Emory, Brown, I believe there's others as well, are quietly allocating to IBIT in particular, but some of the other ETFs. And I'm curious what you make of institutional allocators. I know they're not using, or I think they're not using moon and lunar cycles to invest capital.
They're certainly not. Well, no, I mean, they are and they aren't. It's funny. Druckenmiller talked about this one time in one of his interviews, and the interviewer just went batshit crazy on him and said, there's no way you actually use this. He says, are you joking? I don't care what I can use to get an edge. I'll use it. You tell me horoscopes will give me an edge, I'll let people read my palm. So, but it is interesting. I mean, there's a lot of people, Paul Tudor Jones, et cetera, talked about this. So the idea that these cycles are real, I mean, it's just data. And it makes a lot of sense on a lot of levels. But they're not doing it. What the endowments are doing is partly intentional and partly, call it luck, because it wasn't luck, but partly happenstance. What I mean by that is, so I came from that world, right? I was the number 2 guy up there at Notre Dame, and I was the number 1 guy down here in Carolina Blue. And I ran endowments. And the reason the endowments have the best performance of anybody else, they're better than the pensions, they're better than family offices. There are certainly some individuals that do better, but of all the institutional investors, the endowments are up here, up and to the right. So why is that? Well, it's a couple things. One is they have the longest time horizon, literally perpetuity. Now, a foundation has perpetuity too, but they have to spend 5% a year. The endowments don't have to spend 5% a year. Most of them do, or somewhere close to that, but they don't have to. And they get more gifts, generally speaking, and that helps with cash flows. So they're constantly able to buy the new idea. But the most powerful edge in investing is time arbitrage. If you have a longer time horizon than other people, you get paid for that. Full stop. Second thing they do better than anybody else is they overweight innovation as an asset class through venture capital. Right? Yale is 23%, Notre Dame's like 20-something percent. We were, 18, 19% at Carolina. So, and they have the allocation to the very best of the very best. So Kleiner Perkins, Sequoia, et cetera, because they were early. Like when we started investing with Kleiner and Sequoia back in the 90s, they weren't famous. In fact, Sequoia was on the verge of breaking up, and we made a bet with Don Valentine, and it turned out really, really great. You've heard me tell the story. We put $500K in Google, it turns into $200 million. That's a good thing. So venture is amazing. So what happened to a whole bunch of these? They're invested in Sequoia. This guy, Matt, convinces Sequoia to buy some Bitcoin. It goes up at first and then crashes. And they say, Matt, why don't you go do this thing, call it Paradigm, and he gets Fred to come down from Coinbase and join him. And basically there's a game. If you're in Sequoia's main fund, you would like to have as much of that fund as you possibly can. So every time they come out with a new product, Sequoia China, you have to do some. Sequoia Israel, you have to do some. Sequoia Europe, you have to do some. Paradigm, not called Sequoia because they were kind of nervous about Bitcoin back then. Got to do something because you're playing the game that, hey, if I support these other things, maybe it'll give me more allocation in the main fund because everybody wants it. So they got into Paradigm, and Paradigm has crushed it. Okay. Second thing is a bunch of them also had done some stuff with Andreessen. I say, I spell my name with a K instead of a C, and I didn't invent the browser, so I'm just not as famous as the other Mark. But he built a nice business, and they raised a crypto fund, and a few, not a big number, but a few of the endowments waded in, and that fund has done really well. And Katie has, gone on to do some stuff. So, so that was part of it. Now lately, and look, I went to all of them in 2017 and 18 and said, let us do it. And they're like, what do you know about crypto? You're not a tech bro. So none of them, not none. We had 2 endowments invest with us, but most didn't. They went with the big dogs. I also went to a whole bunch of people, endowments, foundations, pension funds, healthcare systems. And Pomp and I made a pitch that we stole from Peter Thiel that was, give us Bitcoin. Give us money. We'll buy Bitcoin. Up to 3 times your money, you pay no fees. And then we split it 70-30 above that. You get 70, we get 30. We got 0 takers at $6,000 price. So would have been good for everybody, but no one did it. Well, now IBIT boomerized investing because now you can tell your board, oh, we just own this ETF. And so they got smart and a little bit lucky to get Paradigm and Andreessen early. A couple have done some other good things as well. But only lately did they jump in. So their cost basis is not, 5,000, 6,000, 8,000, 10,000, but it's lower than, where we are today.
Mark, could I ask you, in sort of the context of endowment adoption and allocations, what do you make of, because a lot of what that article in Institutional Investor calls out is kind of like the persistent stigma around sort of broader crypto, digital assets. People still have PTSD from FTX, et cetera. And so the spirit of the article was like, they're slowly accumulating and beginning to make these positions, but they really don't want to talk about it because they don't want to have to justify it to colleagues, peers who maybe, particularly the past year or so, lump in Bitcoin with like, oh, that's just a Trump thing, right? And so there's a lot of politics around it effectively. And so what do you make of that? And I guess what are you seeing on the ground in your circles in terms of that stigma, the differentiation between Bitcoin and the rest of crypto and how people are going about it?
So 2 things. One, negative headlines sell. You're never going to get, look, Institutional Investor is a great publication. They're great. And, I've had the privilege to be in a couple times and they are a great organization. Man, they're going to write the headlines the same way, the asset no one wants to talk about. It's just not true. It's true in the sense that, sure, there are doubters. There are alumni who are doubters. There are board members who are doubters. There are faculty who are doubters. But they doubted, the faculty would have had you sell all your shares of Nike years ago because they sewed soccer balls in China or whatever. They would have had you sell all your oil companies. So faculty's been on the case of the investment firm. At some point, you get to the point of, okay, well, what can we invest in? Well, I can't invest in government treasuries because government's an instrument of war. I can't invest in, birth control, so I can't do biotech. I can't invest in, oil and gas because that hurts the environment. So what can you invest in? So that war has been going on forever. So, they're doing the FUD about, it uses too much energy. I'm like, you mean more than the banking industry, which is like 30 times more? I mean, do you use a bank? Do you go to a bank branch? I mean, that uses a lot of energy. So I think that's part of it. I think the other part is negative headlines. I'll give you examples. Our first institutional client was not an endowment. Endowments did come in, but our first institutional client was a municipal pension fund in Fairfax County. Incredible CIOs, leaders, just not afraid to do what's right for their pensioners, but take a lot of heat. And, in the board meeting, and I may have already told you on the last time we got together, but in the board meeting, the chairman, who is a policeman, like in uniform, gun and helmet on the table, Harley outside, says, yeah, Mark, I hear what you're saying. Get it. But you want me to tell my guys I just put their pension in drug dealer money? Like, no, I do not want you to tell them that. But okay, I see your point. Said, no, what I want you to tell them is making 7.5% long-term is hard, right? And you're a fiduciary and you have to do it. And so the only way to really do that, and that was back when interest rates were 0. So the only way to do that in a ZERP world is to invest in innovation through venture capital and new technology. He says, all right, I get behind that. And so next day, the Washington Post has an article, pension fund invest in drug dealer money. And yet he was quoted, no, we as fiduciaries have to make 7.5%. So we need to invest in innovation and venture capital, almost word for word. And look, I just sent them back last week, $3 for every dollar they put in. And we have another $5 to send them back next year. So I was up with them a month ago and they're very, very happy. They're still doubters. There's still people on the committee that think it was a mistake. People don't like what they don't understand. That's always been the case. They don't like what they didn't do, right? I'll give you another one. So I shouldn't throw them under the bus, but my beloved university, big picture back there, right? My wife and I stole an idea from a scholarship program down here called the Morehead Scholars, which is a merit-based program where you try to convince people that were going to go to Harvard, Yale, Stanford, Princeton to come to Carolina, and you give them a special scholarship and special privileges and special teachers. And And it was been successful over the last 40 years of getting some of the greatest people on planet Earth to come to Carolina and go to school here. We're like, let's do that in Notre Dame. So we go up there, you know, it's back in whatever it was, 2006 or 7. They're like, no. What do you mean, no? Like, we don't believe in merit. We only think you should give scholarships to people in need. About no, there's nothing wrong with merit. Merit is good. Merit is what builds everything. I mean, you wouldn't have these buildings if it weren't for merit. They all have names of people who were very meritorious, by the way. Blew me away. Now, I'm persistent, so I persisted, and we did get them to take our gift, which is hilarious. But the point is that institutions, there's no upside, right? They don't have big bonuses. Board members don't get bonuses. That's why groups make bad decisions, right? If you ask a group of a board to do Bitcoin, they're like, well, if I say yes and it doesn't work, then I get kicked off. I kind of like coming to football games and basketball games. I kind of like being able to say I'm on the board. So they will always dumb down to the lowest common denominator and say, oh, let's just put it all in index funds because then I don't get fired. It takes really strong leadership at the CIO level or at the board level. A lot of, Notre Dame has a great board chair, amazing board chair. We had great leadership down here, Carolina. Duke has great leadership. Stanford, I mean, there's a lot that have good leadership, but some don't. And that's really the difference. You need to be bold, and being bold has consequences sometimes. And I don't know, I get why Institutional Investor wrote that article, right? Because it sells newspapers. And in a backhanded way, they're kind of complimenting them, but not really, right? It's a compliment. I live in the South. It's the bless your heart. That's not a compliment.
Yeah.
When someone in the South says bless your heart, they're like, fuck you. That's what they're saying.
It's
Because
funny.
they're either pissed off that they didn't do what you did, right? Or they're pissed off that you have an idea that, move down here. And I shouldn't pick on the South, but I moved down here from the North, and we go to put money down on a house. And it wasn't done yet. And I said, all right, I want to have a $5,000 holdback in case, they don't finish the house, right? And the broker, very Southern woman, says, oh, we don't do that down here. Like, what? You don't protect yourself? You don't do intelligent things? What? No, we're not rude. Like, are you joking? I want to protect myself. And of course, the end of the story. They didn't finish the house, and I still paid the money. And I joke, in North Carolina, there's no word for mañana because there's nothing with that sense of urgency, right? When they say we'll be back tomorrow, that means 3 months, 6 months, 12 months. It's bad, but I love it.
There's a lot there. Just a random anecdote. I was up in Dallas, and I have an investment banker friend. There's an annual event. It's philanthropic event where all the banks go and attend, and he asked me to go and join, and he's been in this space for a while. And long story short, about this event, he's introducing me to a bunch of people, and they asked, well, what do you do, obviously? And it was the bless your heart, a very kind, at least 5 to 7. They were all great people, but it was all like, oh, good, good for you.
Good for you.
But going back to
crypto kid, nice.
We'll see you back. That was a funny anecdote. When I started this business, my mother-in-law,
you'll come begging us for a job.
That was the anecdote my mother-in-law brought up back in the day when I started this business. She goes, I'm curious, could you ever go work at BlackRock and Fidelity if it didn't work out? And she's just being sweet, but I just sat there and I'm like, do you know how much of a just slap?
And they actually don't mean it as a slap because they don't actually think the second thought, right?
Yeah.
They think they're being nice, but look, we all chose to be here. And that choice is hard, right? And hasn't worked out perfectly all the time. And there are plenty of nights, I sweat about promises I made to LPs and promises I made to my family. And look, no one's crying for us. Everything is fine, but it's hard. But everything worth doing in life is hard. Working out is hard. Having a strong relationship is hard. I mean, everything in life that's worth it is hard.
Here's what keeps Bitcoiners awake. You're still securing millions of dollars the same way you secured thousands. That hardware wallet in your drawer, your family's entire future depends on you not losing it, forgetting the PIN, or something happening to you. Onramp's multi-institution custody removes that burden. 3 independent institutions hold your keys, no single point of failure, no seed phrases to protect, no explaining complex recovery processes to your spouse. And now we're offering flat tier pricing. One predictable monthly fee starting at $250, whether Bitcoin is at 100K or 500K. Plus, with Onramp IRAs, you get the same institutional security with tax advantage growth. This is how smart investors protect generational wealth without the weight on their shoulders. There's strength in many. Learn more at onrampbitcoin.com.
I want to go on to that because there's 2 themes you touched on that tie into like the venture aspects. One is the thing we come up with a lot and we talk about with our clients and in the existing market is that this is for the first time in a been emergent asset. So individuals have adopted it, and it's really simple. It's because it's a consensus of 1, maybe 2 if you have to talk to your significant other about, going very long, versus when you look at pubcos, endowments, institutions, you sit around a room and they're just like, somebody's like, nobody's gonna get fired for not, going a different direction.
Yep.
So because of that, we see that in our thesis is that the category winners long term will come from outside of those markets because of just naturally, and also they're the most sophisticated because they've had the longest time in the market, so they had to figure out all this crap that everyone else is just barely getting into it by just YOLOing into a third party custodian saying trust BlackRock and the rest of it. But I'm curious your take on how you think about so. There's venture capital allocating to meritocratic organizations, the things that we're recognizing you want. But then there's the legacy firms that haven't been able to be disrupted because of the existing regulatory and everything that exists in that apparatus. And for the first time, it feels like we're seeing it kind of come to a head, whether it's like Tether and stable coins, and we saw JPM now with their tokenized deposit that'll be able to offer yield, potentially them offering the structured products. Yes or no, competing with MSTR, custody coming out, and what is it going to look like? I'm just curious how you think about that market playing out in the middle, short, and long term. We have our view, but we want to hear yours.
No, look, and I apologize because I'm have to run here, but I want to come back and dig into that because there's a whole bunch of things in your question. Again, just so much insight that are critical to not whether we're going to end up where we all believe we are in a digital first future. We are, but how long it's going to take. And it has to do with these regulatory things. And it's like little things like the be careful what you ask for, you might get it, right? Everyone's like, oh, yay, we got classified as a commodity, not a security with Bitcoin. That was not a good thing. That was intentional. That was, we're going to tame Bitcoin because if it's a commodity, then we can have futures on it and we can FUD it and spoof it. So be careful what you ask for. Same thing with the Genius Act. The Genius Act has some elements that, and again, this is why we need to do it in another show because I can go deep into this. If you were a country that knew you couldn't pay back your debt, and you had very smart technology people, you would create a new accounting system, very similar to what the UK did in the 1840s. They had a debt problem. They had everybody kept track of debts, believe it or not, using pieces of wood. They were called tally sticks. There was no dual entry accounting yet. No, green eye shade, ledger pads. And long story short, they had the epiphany that if they gathered up all the tally sticks and destroyed the evidence, they could erase all the debt and start over. And so if you had borrowed money, you didn't have to pay it back. So you got super rich. And the people who were owed money got super poor. But the government was good. And so they started over and adopted the dual entry accounting from the Medicis. And you guys should have Pippa Malmgren on the show and talk about it. She talks a lot about this. And her dad was, a longtime political guy in Washington. So again, God rest his soul. But long story, if you created Bitcoin as a triple entry accounting system, and then you forced through the Genius Act all of these new digital assets to be backed by treasuries, you're kind of forcing this new triple entry accounting system. And again, we can go down the sinister path of then you're just one step away from CBDCs and controllable money, programmable money, which again, we've all seen the Augustin Carstens thing. That's a scary future. I think I don't believe in coincidences. I don't believe Gary Gensler was a coincidence, right? He was appointed by the guy whose biggest donor was Sam Bankman-Fried, and he worked for Sam Bankman-Fried's girlfriend's dad. It's not a coincidence. None of that's coincidence. It's not a coincidence that, Ms. Warren, funded by the banks, was the, initiator of Operation Choke Point 2.0. And I think we're now in Operation Choke Point 3.0. And everybody loves the Donald, and he's a fan favorite in crypto. But at the end of the day, let's remember who he was for most of his life, which side of the aisle he stood on. Let's remember what he really cares about in terms of dollars and cents. And let's think about who invested in Tether right before he was appointed Secretary of Commerce. So I said, there's a lot to unpack there. And I don't think it's all sinister, but I do. If you read the Genius Act really closely, it's got some dark side to it. And if you read the Clarity Act really closely, it's got some more dark side to it. I think long term, we'll still win with Bitcoin. And I'll leave you this, and I got to run. Yeah, I told you the one time that I had this fear that, it was created by the CIA and there was a backdoor and they were going to steal all the money, right? And so I asked Scott Stornetta, who was our venture partner, what do you think? He's like, no. Like, you didn't even think about it. He's like, I don't have to think about it. It's impossible. There's an air gap. He said, with Ethereum, it could happen. It's like, oh, okay. Again, topic for another day. So I don't worry about that anymore. So I don't worry about them stealing it, but I do worry about whether we like it or not. We don't live in Balaji's nation stateless world. I think it'd be awesome, but we don't live there. And the threat of violence is still real, right? Don't pay your property taxes, see what happens, right? So I do think self-sovereignty requires what you guys do, and love you for doing it and love all the people you're helping do it. But I do worry that there's another group that's planning a different future. And I haven't watched it yet. I just sent it to myself. There's a podcast on an AI guy talking about that. We're only 2 years away from some of the things I'm talking about. So I'm going to watch it over the weekend. And I'll come back to you after I
we know you got to run, but I'll leave you 2 things. Yeah, base case 1929, 2029, that whatever you're describing, that's 100 years cycle of whatever you're saying. But the other side of it, I think the mental model, you've probably thought of this. If not, you'll appreciate it. It's the same thing as the internet. Like, the internet opened up, but the architecture is pretty much permissioned, but it still offers edge cases, and you can't shut down the internet. And and it changes that logic and ROI of violence. It's the same thing that's happening right here. It's just a constraint.
You can't, Michael. You can't accept the little thing that happened with the
register?
The OpenAI browser, where the guy said, show me pictures of Hitler, is like, no. So you can shut down the internet. You can not only control what people see and how they see it, but then they had the funny part about, and we've reported you to the proper authorities. So
well, what I'm referring to is if you locally host your model, that's the same thing as like being open your own.
Right. I mean, there are ways around that, VPNs, but my point is that people say, we can't shut down Bitcoin, let's shut down the whole internet. Even that doesn't work because we could exchange, using stuff in our brain. But, and maybe if we all have chips, then we won't be able to do that either. But anyway, more for another day.
We'll have to have you back, funny. Mark.
But when we set this up for an hour and a half, I'm like, there's just no way we can talk now. But I talk too much, so we did.
No, we love it. We'll send you some follow-up info. Hopefully, we'll get you back on soon. Have a good rest of your day.
One more thing, Mark. Notre Dame, BYU, blind resume. Who gets in?
I think it all just comes down to this weekend. I mean,
yeah, if BYU wins, all right.
I think the BYU against Texas Tech a couple weeks ago doesn't belong anywhere near the CFP. If a different team shows up on Saturday, I'll change my mind. But that team that was playing Texas Tech is not a very good football team. At least I didn't see it.
Fair take.
But
the last trade, college football.
Actually, I just tweeted about this. College football is an F1 race. It's not how you were on lap 1 or 2 or 3 or 4. It's the last lap. And if you're in third place and someone else is in 7th, you don't get to say, I passed them on the first lap. Doesn't matter. You're in 7th place. So where you are matters. And the problem is, like an F1 race, you're seeded and you can say, well, BYU got a shitty starting position. Yes. So that meant they had to drive better, maybe not fairly, but they had to drive even more better than Notre Dame or anybody else. So I can argue both sides, but I'm just saying the team I saw play Texas Tech, I wouldn't put in the CFP. But if they show up a different team on Saturday, then I'll change my mind.
We shall see. Thanks, Mark.
Thanks, Mark. Have a good one.
Appreciate it.
Guys.
Thanks for listening to this week's episode of the show. If you found the information valuable, please share the episode with a friend or leave a rating on your favorite podcast app. All the links we discussed in today's show will be in the show notes inside your podcast app. Before we finish, a quick reminder that Onramp Media is for informational and entertainment purposes only, and nothing should be construed as investment or legal advice. Regardless of where you are on your Bitcoin journey, we'd love to hear from you. Visit onrampbitcoin.com/contact to schedule a consultation with one of our private client advisors.